What is happening right now? While you are listening to this story, somewhere in the Atacama Desert in Chile, salty water is evaporating under the scorching sun. In Western Australia, huge excavators are breaking rock. In Argentina, pumps are drawing brine from beneath salt flats. All of them are extracting the same thing, lithium, and all of them are falling behind. Let us look at the reality of December 2025. Lithium prices. June 2025, $8,259 per ton, a 4-year low. December 2025, $13,003 per ton, an increase of 57% in 5 months. Forecast for 2026, up to $28,000 per ton, a tripling of the price. What happened? Why did the price jump by 1.5 times in half a year? A paradox. Surplus turns into deficit. In 2023-2024, the lithium market faced a temporary surplus. Producers extracted 22% more lithium than was required. Prices collapsed from $77,041 per ton, the peak of 2022, to $8,259 in June 2025, a loss of 89% of value in 2.5 years. Sounds like a catastrophe, right? But here's what happened next. September 2024, a Chinese giant shuts down the largest mine. CATL, the world's largest battery producer, closed the Jiangxiawo mine in Jiangxi province. 3% of global lithium supply disappeared overnight. 2024-2025, a wave of mine closures. Mineral Resources in Australia reduced production at Mount Marion by 21%. Bald Hill in Australia was closed and put into conservation. Dozens of small producers around the world stopped extraction. Why? Because at a price of $8,000 to $9,000 per ton, most mines were operating at a loss. The result, the market reversed instantly when supply shrank and demand continued to grow. July 2025, prices jumped to $12,067 per ton, an increase of 46% in 1 month. November 2025, they reached $13,003, an increase of 57% since June. December 2025, Chinese futures are trading above 92,000 yuan, $12,800. The main lesson for an investor: the lithium market is not ordinary raw material. It is a pendulum. When prices are high, everyone extracts. A surplus appears, prices fall, mines close, a deficit emerges, prices soar, extraction resumes again. But this time, something has changed. Demand is growing so fast that even at peak extraction, the world cannot keep up. Revolution 1, electric vehicles are devouring lithium. 1 electric vehicle equals 10 kilograms of lithium or more. Let us break down the numbers. A typical electric vehicle, battery capacity 60 to 80 kilowatt hours. Lithium in the battery 8 to 10 kilograms of pure lithium. In the form of lithium carbonate 50 to 63 kilograms. Tesla Model 3 long range. Battery 82 kilowatt hours. Lithium approximately 12 kilograms. An electric truck or bus, battery 300 to 500 kilowatt hours. Lithium 40 to 60 kilograms. Electric vehicle sales in 2024 to 2025. Year 2024. Sold 17 million electric vehicles worldwide. That is 170,000 to 200,000 tons of lithium just for cars. Year 2025, forecast, sales 20 million electric vehicles, plus 18%. Lithium consumption more than 220,000 tons. But this is only the beginning. Year 2030, 45 to 50 million electric vehicles per year. Year 2035, more than 70 million. By that point, half of all cars will be electric. China is rewriting the rules of the game. October 2025. In China, electric vehicles for the first time took 51.6% of the market. Read that again. More than half of all sold cars are electric. China is not just a leader. China is showing the future to the entire world. China's new target for year 2027. To double the capacity of charging stations to 180 gigawatts. To build millions of new chargers. Subsidies for the purchase of electric vehicles and batteries. Ganfeng Lithium, the largest Chinese lithium producer, forecasts demand growth of 30% in 2026. Revolution 2. Grid-scale energy storage is a quiet bomb. Here's what most investors miss. Electric vehicles equal 70% of lithium demand, but energy storage equals 15% and is growing the fastest. The United States, from 0 to 40 gigawatts in 8 years. Year 2017. The Industry Association set an ambitious goal of 35 gigawatts of batteries by 2025. Everyone thought it was fantasy. The result, in 2025, July 2025, the United States crossed the threshold of 35 gigawatts. October 2025, 40 gigawatts of installed batteries. Third quarter of 2025, 4.7 gigawatts installed, more than in the entire year 2020. The target for 2025 was beaten half a year early. Why did this explode? Battery prices collapsed. Year 2010, $1,200 per kilowatt hour. Year 2024, $117 per kilowatt hour. December 2025, $108 per kilowatt hour, a new record. For grid-scale storage, it is even cheaper. Year 2024, $127 per kilowatt hour. Year 2025, $70 per kilowatt hour, a drop of 45% in 1 year. Energy storage systems became cheaper than batteries for cars for the first time. What does this mean in practice? California, Texas, Arizona, 80% of all battery storage in the United States. In Texas, batteries save the grid during heat waves. In California, batteries store solar energy for the evening peak. Redwood Materials, founded by the former chief technology officer of Tesla. By 2028, 20 gigawatt hours of storage from used electric vehicle batteries. Investments, $350 million. The global market, year 2024, 90 gigawatt hours of grid storage installed. Year 2030, forecast of 387 gigawatts of new capacity. Growth of more than 30% per year. Revolution 3, portable electronics and everything else. 5% of the lithium market. Laptops, tablets, smartphones, power tools, medical devices, drones. 10% of the market are electric trucks and buses. Amazon ordered 100,000 electric vans from Rivian. China is converting all public transport to electric power. DHL, FedEx, UPS, all are investing in electric trucks. Revolution 4, home energy storage. Tesla Powerwall, LG Energy, Sonnen. People install batteries at home. They store solar energy. They protect themselves from power outages. Base Power in Texas. October 2025, $1 billion in investment. Battery rental to homeowners. 100 megawatt hours already installed in Texas. Total demand for lithium. Year 2025, 1.4 million tons of lithium carbonate. Year 2030, 4.6 million tons, plus 229%. Year 2047 to 8 million tons. Growth by a factor of 5 in 15 years. Reality. New deposits cannot keep up. This is the most important part of this story. The current market balance in year 2025. Fast Markets, a leading analytical agency, year 2025, a surplus of only 10,000 tons, 0.7% of the market. Year 2026, a deficit of 1,500 tons, the International Energy Agency. Year 2023, a temporary surplus of 11,000 tons. Year 2030, a deficit of 97,000 tons. Year 2040, a deficit of 621,000 tons. Read that last number again, 621,000 tons of deficit. That is 60 times larger than the entire global deficit in year 2026. Why new mines will not solve the problem? Time to launch is 5 to 10 years, from exploration to the first ton of lithium. Geological exploration takes 2 to 3 years. Licensing and permits take 2 to 4 years. Mine construction takes 2 to 3 years. Production ramp-up takes 1 to 2 years. In total, 7 to 12 years. From idea to the first shipment of lithium. The problem is that demand triples in 5 years. Mines cannot keep up. Cost is billions of dollars. A new lithium mine. Australia, hard rock, $500 million to $1.5 billion. Chile or Argentina, salt flats, $300 to $800 million. United States, new technologies, $1 to $2 billion. Examples. Thacker Pass in Nevada, United States, more than $2.3 billion of investment. Mariana in Argentina, Ganfeng, $790 million. When the price was $8,000 to $9,000 per ton in year 2024, investors refused to finance new projects. Why invest $1 billion if payback is in question? Geographic concentration is a geopolitical risk. 80% of global lithium production. Australia, 60%. Hard rock, spodumene. The largest mines are Greenbushes, Mount Marion, and Wodgina. The problem is dependence on exports to China. Chile, 20%. Salar de Atacama, the largest deposit in the world. The problem is a water crisis and environmental protests. China, 15%. The provinces of Jiangxi, Sichuan, and Qinghai. The problem is that China controls 64% of global lithium processing. Argentina, 5%, a fast-growing player. The problem is an unstable economy and inflation. The number one risk is that China controls the supply chain. The United States imports 66% of lithium-ion batteries from China, 70% of processed lithium from China. October 2025. China introduced export restrictions on advanced battery technologies. This is not a ban, but a more stringent approval process. But the signal is clear. China is using lithium as a geopolitical weapon. The response of the United States. Partnerships with South Korea. LG Energy Solution. Partnerships with Japan, Panasonic. Incentives for mining in Nevada and North Carolina. But the United States is 5 to 10 years behind in building processing facilities. Environmental constraints, lithium extraction from salt lakes in Chile and Argentina. It requires 500,000 gallons of water per 1 ton of lithium. It dries out underground aquifers. It threatens fragile desert ecosystems. Protests by indigenous communities. In Chile, Atacama tribes are fighting against the expansion of mining. In Bolivia, the Salar de Uyuni deposit, the largest in the world, is frozen due to disputes. Hard rock mining in Australia. Open pit mines destroy landscapes. High energy consumption during processing. The result is that new projects face years of delays due to environmental reviews. Resource depletion. Known lithium reserves. Bolivia, 23 million tons, undeveloped. Argentina, 22 million tons. Chile, 11 million tons. Australia, 7.9 million tons. China, 6.8 million tons. Worldwide total is approximately 105 million tons of proven reserves. Sounds like a lot. Let us calculate. Demand from year 2025 to year 2040. Average demand is approximately 5 million tons per year. 15 years multiplied by 5 million equals 75 million tons. By year 2040, 70% of known reserves will be depleted. New deposits will be found, but they will be more expensive to develop. They will be located in hard-to-reach areas. They will face even stricter environmental constraints. The conclusion of this part. The world knows that lithium is needed. The world knows that demand will triple. But the world cannot extract it fast enough. This is a classic recipe for rising prices. 3 ways to invest in lithium. Method 1. Lithium producers, lithium miners. The largest companies year 2025. Albemarle Corporation, ticker ALB, United States. The largest lithium producer in the world. Production in Chile, Australia, and the United States. Advantage. Vertical integration. Price. Shares at a cyclical bottom. SQM Chile, Salar de Atacama. Advantage. Low cost of extraction. Risk. Dependence on a single deposit. Ganfeng Lithium, China. Production in China, Mali, and Argentina. Contracts with Tesla, BMW, Volkswagen, and LG. Advantage. Aggressive expansion. Pilbara Minerals, Australia. Pilgangoora, Western Australia. Hard rock mining. Fast capacity ramp up. Mineral Resources, Australia. Mount Marion, and Wodgina. Vertical integration. Mining plus processing. Rio Tinto, ticker RIO, acquired Arcadium Lithium for $6.7 billion. Target, more than 200,000 tons of LCE by year 2028. Argentina and Australia. Method 2. Battery manufacturers. CATL China, 37% of the global market. Clients, Tesla, BMW, Volkswagen. Vertical integration. LG Energy Solution, Korea. Plants in the United States. Reduction of dependence on China. Panasonic, Japan, partner of Tesla. Focus on premium batteries. Method 3. ETF and diversification. Global X Lithium and Battery Tech ETF, ticker LIT. More than 40 companies across the entire value chain. Lower risk than an individual stock. Amplify Lithium and Battery Technology ETF, ticker BATT. From mining to electric vehicles. Financial logic. Why lithium? Conservative scenario. Years 2025 to 2030. Price $18,000 to $25,000. Producers revenue. Growth by 2 to 3 times. Shares 100 to 200% over 5 years. Return on investment 15 to 20% per year. Bullish scenario. Price $30,000 to $40,000. Supply deficit. Shares 300 to 500%. Return on investment 30 to 40% per year. Comparison of alternatives 5 years. S&P 500 8 to 10%. Medium risk gold 5 to 7%. Low risk oil 10 to 15%. High risk lithium 20 to 40%. Medium to high risk. Copper 12 to 18%. Medium risk. Risks of investing in lithium. High cyclicality and volatility. Alternative technologies, a 5 to 10 year horizon. Growth of battery recycling. Geopolitics, final recommendation. For a horizon of 5 to 10 years, 40% lithium producers, 30% ETF, 30% battery companies, expected return 20 to 30% per year. Suitable for long-term investors. Not suitable for a 1 to 2 year horizon and low tolerance for volatility. Lithium is not just a metal. It is the foundation of the energy revolution. 3 facts. 1. Demand will triple by year 2030. Electric vehicles, energy storage systems, everything requires lithium. 2. Supply cannot keep up. New mines take 5 to 10 years to come online. 3. A deficit is inevitable. By year 2030, there will be a shortfall of 97,000 tons. By year 4,600, 21,000 tons. Lithium prices have risen by 57% in 5 months. This is not an anomaly. This is the beginning of structural growth. If you are ready to endure cyclical fluctuations and hold the investment for 5 to 10 years, lithium may become one of the best investments of this decade. The window of opportunity is open, but it will not remain open forever. The data is current as of December, year 2025. This is not financial advice. Always conduct your own analysis.